For over a decade, the cryptocurrency ecosystem has operated with intense, unpredictable market volatility that routinely wipes out retail investors. The Russian government is now attempting to domesticate that volatility. A newly signed federal law officially legalizes the trading of digital assets on public markets for everyday citizens. The Bank of Russia, led by Governor Elvira Nabiullina, is terrified of exposing non-qualified everyday citizens to the market's sharp and unpredictable fluctuations. To manage this perceived danger, the government refused to simply open the floodgates. Instead, they engineered a massive elimination system designed to block 99.9% of all existing cryptocurrencies from the public. This directive creates a permanent tension between the decentralized freedom of cryptocurrency and the rigid requirements of state-mandated consumer protection. The central bank built a regulatory funnel on 3 strict metrics: massive market cap, high trading volume, and a 5-year pricing history. Pour the crypto market through this filter, and almost everything disappears. Exactly 3 tokens survive for the public: Bitcoin, Ethereum, and Tether. Even then, access is capped. Retail investors hit a hard ceiling, restricted to 300,000 rubles per year. Before a single ruble can be spent, every investor must pass a legally mandated risk assessment. They have to explicitly prove they understand the financial danger of the assets they are about to buy. Tether's presence on this shortlist is a point of friction. Just recently, the stablecoin issuer froze millions in USDT tied to sanctioned Russian crypto exchanges. Yet in the central bank's baseline formula, pure mathematical liquidity and a proven global track record ultimately superseded that geopolitical friction. By the central bank's own mathematical standards, XRP should be on the list. Created in 2012, the token maintains the required market cap, trading volume, and 5-year pricing history. Why was a token that meets every quantitative metric explicitly banned from the retail trading list? The Bank of Russia is applying an unwritten, qualitative filter. They demand absolute institutional stability, not just high trading volume, and XRP carries an unacceptable amount of regulatory baggage. For years, XRP was entangled in a high-profile lawsuit with the U.S. Securities and Exchange Commission. That legal battle caused the token to be repeatedly delisted and relisted across various platforms, staining its stability profile in the eyes of Russian regulators. The exclusion of XRP reveals the central bank's true priority. They are attempting to entirely sanitize the retail market, shielding citizens from any asset carrying a hint of institutional controversy. Through strict asset filters, financial limits, and mandatory testing, Russia has painstakingly engineered a sanitized sandbox meant to keep the average citizen safe. But further down the directive's text, the logic shifts. This entire regulatory funnel, the 300,000 ruble cap and the 3-coin limit, does not exist for qualified wealthy investors. Russia's accredited whales are entirely exempt. They are explicitly allowed to acquire all cryptocurrencies on exchange and over-the-counter markets, without a single restriction on volume or asset type. The state is dictating 2 starkly different realities. Retail traders are locked into a mandate of extreme mathematical safety, while the wealthy are granted unrestricted access to high-risk speculation. This framework is a 2-tier system that actively stratifies financial freedom. It mandates mathematical protection for the retail class while shielding the wealthy from those same restrictions, dividing risk tolerance by socioeconomic status.